Let's now discuss about option contracts. We said that there are two types of option contracts. The first is a call option and the second is basically a put option. Let us actually see how that fits the definition of derivative. Now, we defined a forward contract as any contract to purchase or sell an underlying instrument after a specific period of time at a predetermined price. All right, a contract to either purchase or sell an underlying after a specific period of time at a predetermined price. In my example, I had taken the case of Reliance shares where I said that I have entered into an agreement to purchase Reliance shares after a specific period, which is after 3 months, at a price which is determined today itself, and that price was 1800. And then we actually saw the accounting. Just like how we bought a forward contract, we could also sell a forward contract. Selling a forward contract is basically an agreement to sell Reliance shares after 3 months at a price of rupees 1800. Now, similarly, within call option also, you can either buy a call option or you can sell a call option. All right, just like how you can buy or sell a forward contract, you can also buy or sell a call option. And similarly, you can buy a put option or you can also sell a put option. All right, selling a call or selling a put is often referred to as writing an option. All right, the word selling is often referred to as writing an option. Let's actually take an example of a call option. All right, let's actually take an example of a call option and we'll see how to actually account for it. Let us say Mr. A, there's a person called Mr. A. He has purchased a call option. All right. Now, what is a call option? A call option basically gives you a right to purchase. It gives you a right to purchase an underlying instrument at a specific price. All right. After a specific period of time, it gives you a right to purchase an underlying instrument for after a specific period of time at a predetermined price. Now, if Mr. A is purchasing a call option, there should obviously be a seller of an option as well. All right. Although I did not elaborate it in the case of a forward, whenever you are purchasing a call option, there should be correspondingly a seller as well. All right. That is true also for shares. Whenever one person is buying the shares, somebody else also has to sell the shares. So over here also, if Mr. A is purchasing the call option, it basically means that Mr. B is probably selling the call option. All right, somebody in the world has to sell a call option, and I am assuming that Mr. B is actually selling a call option. Now, call option, remember, is a right to buy a particular underlying. It's a right to buy a particular underlying at a predetermined price after a specific period of time. In case of a forward, you entered into a contract to purchase it at 1800. Let us actually take some fresh numbers over here so as to get an understanding. All right, I am probably assuming that actually the underlying shares are Infosys shares. I'm assuming that the underlying shares are Infosys shares and there is a strike price. In case of an option, you have something called as strike price. This is the predetermined price that I was talking about. You have a right to buy an underlying, which is Infosys shares, at a predetermined price or strike price of, let us say, rupees 900. All right, I'm assuming that the strike price is rupees 900. And let us say the maturity, like in previous example, is say 3 months. Now, in case of an option contract, there is an upfront premium that is required to be paid. All right, there is an upfront premium which is required to be paid. So Mr. A actually pays a premium to Mr. B on day one at the inception of the contract. At the inception of the contract itself, Mr. A typically makes a premium payment to Mr. B. All right, but at the inception of an option contract, unlike forwards, and in case of options, we actually make an upfront premium payment. Let us say the upfront premium payment is actually equal to 10 rupees. All right, I'm assuming that the upfront premium is equal to rupees 10. So on day one, A is actually going to make a payment of rupees 10 to Mr. B. All right, so A is making a payment of rupees 10 to Mr. B. Let us now see if this option contract, if this call option is satisfying the definition of derivative. Now, if you think of it over here, the upfront amount that I'm paying is rupees 10. All right. There is an initial investment. Unlike a forward, in case of an option, there is actually an initial investment, but this initial investment is actually low. All right. It is very little. All right. So this actually satisfies condition number two. Condition number two states that in case of a derivative contract, the initial investment is either supposed to be zero or it is supposed to be very small. All right, now 10 rupees is considered to be a very small amount. What is a very small and not a small amount? We'll actually see as we progress through the examples. But over here, 10 rupees is considered to be a small amount, and therefore condition number two is actually satisfied. The initial investment is a small amount. Condition number three is that it should be settled on a future date. All right. It should be settled on a future date. Over here, after 3 months, A has got a right to buy the share. A has actually got a right to purchase the shares. So after 3 months, A can actually pay 900 and he will get one Infosys share. All right. So it's going to be settled on a future date. So condition two and condition three are actually satisfied. Let's actually think of condition one. Condition 1 states that the value of this call option should change in response to an underlying variable. All right, when the underlying variable, which in this case is the Infosys share price, changes, then the value of the call option should also change. That is condition number 1. To see if condition 1 is getting satisfied, let us actually take two scenarios. Just like the previous example, let us also take two scenarios. At the end of third month, let's say at the end of third month, I am taking scenario one. All right, let us say I'm taking scenario one where the market price of Infosys shares is, market price of Infosys shares is, let's say, equal to rupees 950. All right, if the market price of Infosys shares is 950, what is going to happen is Mr. A will actually exercise his right because he has a right to purchase the Infosys shares at a price of rupees 900. The market price is 950. Therefore, Mr. A will actually exercise his right. Therefore, Mr. A is going to exercise his right. A will actually exercise his right. Right? So if Mr. A exercises his right, the value of this option can be regarded as rupees 50. All right. Why is it going to be 50? Because A will pay 900 and he is going to actually receive a share which is worth 950. Therefore, the value of this option is basically going to be 50 rupees. All right. The value of the option is going to be equal to 50 rupees. The value of call option is going to be equal to rupees 50. Now let us say I'm taking another scenario. I'm taking scenario 2. Let us say if the market price is actually equal to rupees 750. All right, the strike price was 900. The market price has fallen to 750 at the end of third month. Over here in this case, A will actually not exercise his right. Remember, this is the key distinction between a forward contract and an option contract. In case of a forward contract, even if the share price fell down, we saw that when the share price fell down from 1800 to 1600, I was still required to actually pay 1800 and get a share worth 1600. Now, in case of option, I actually have a right to decide whether I want to buy it or not. All right, where I have a right to decide, Mr. A has a right to decide whether he wants to buy the share or not. And if the market price is 750, he will decide not to buy. All right, I have a choice in this case. In case of a call option, I have got a choice, whereas in case of a forward contract, I actually do not have a choice. So therefore, A will actually not exercise his right. All right. Therefore, A is actually not going to exercise. A will not exercise his right to purchase. Now, if he is going to not exercise the right to purchase, the value of the option is basically going to be equal to zero. It's going to be equal to zero because I'm neither going to pay anything nor am I going to receive anything. Therefore, the value is going to be regarded as zero. All right. The value will actually be equal to zero. Now, if you notice, the value of the option in this case is actually fluctuating. The value of the option in this case is fluctuating based on the change in underlying variable. If the market price increases, then the value of the call option is increasing. If the market price decreases, then the value of the call option is actually decreasing. All right. So the value of the call option is going to be equal to zero if the market price is less than the strike price. All right. If the market price is less than the strike price, if the market price is less than the strike price, then the value of a call option on maturity, obviously I'm talking on maturity only. I'm talking about this on maturity. Then the value of the call option is going to be equal to zero. The value of the call option will actually be equal to zero. Call option will have a positive value when the market price is greater than the strike price. If the market price is greater than the strike price, then the value of the call option will actually be positive. The call option is going to have a positive value. All right, so therefore, this actually satisfies the call option, satisfies the definition of derivative because the value of the call option varies depending on the change in underlying variable. If the Infosys share price increases, the value of the call option goes up. If the Infosys share price falls, then the value of the call option falls down to zero. All right, so this is going to be regarded as a derivative because it satisfies all the three conditions: condition 1, condition 2, and condition 3. Condition 2 is also satisfied. Although there is an upfront payment that we are doing of rupees 10, it is still going to satisfy the definition of having a low initial investment. All right. So all the three conditions are satisfied and hence it will be regarded as a derivative contract. Now, if you actually look at it, the value of a call option over here will actually always be either zero or positive. The call option as a buyer, all right, from A's point of view, from Mr. A's point of view, the call option can actually never have a negative value. The call option can never have a negative value. It will either have a positive value or at most it can fall down to zero. Unlike in case of forward contract where you could have either a positive value or a negative value. You could have either a positive value or a negative value in case of a forward contract, but over here it will either be positive or at most it can actually fall down to zero. All right, so the value of the call option will be positive or will actually be equal to zero. There are three differences that we discussed between a forward contract and an option contract. The first difference was in case of a forward contract, there's no initial investment. In case of an option contract, you have an initial investment. Now, the second difference is in a forward contract, you're always obligated to honor the contract, which means even if the share price falls, you actually have to pay the predetermined price and purchase the share. For example, if this was actually a forward contract, even if the share price falls down to 750, you would have been obligated to pay 900. You have to pay 900 and receive a share which is worth 750. All right. Whereas in an option contract, you have a right. Mr. A, which is who's the buyer of the option, has got a right. All right, the buyer has got a right to decide whether he will exercise or not exercise the option. And in this case, where market price falls below the strike price of 900, we can actually choose not to exercise the option. All right, we can choose not to exercise the option. All right, so that is the second difference. The third difference is basically stemming from the second difference only. All right, if let us say this was a forward contract, you were purchasing a share which is worth 750 by paying 900, which means that the value for you was a negative 150. It was negative 150 because you are paying 900 but getting a share which is worth 750. But over here in scenario 2, you're actually not paying anything or not receiving anything when the market price is 750. Therefore, the value of an option contract can never go negative. The value of a forward contract can fluctuate between positive or negative, whereas the value of an option contract can never actually go negative. All right. Obviously, I'm talking from the viewpoint of a buyer only. I'm always talking from the viewpoint of buyer. So it will be negative for a seller. All right. For a buyer of an option contract, it can never go negative. All right. So for Mr. A, all the discussion that we were doing was obviously from the point of view of Mr. A. All right. For Mr. A, this option contract can actually never have a negative value. But if this was a forward contract, it could actually have a negative value. So these are the three differences between a forward contract and an option contract. Now, not only does this contract also satisfies the definition of a derivative, it also satisfies the definition of a financial asset, because financial asset was defined as a contractual right to exchange a financial asset under favorable conditions. All right, it was defined as a contractual right to exchange a financial asset with another entity under favorable conditions. Now, if you think of it, A actually has a right, and let's say we are under scenario 1, A has a right to receive a share which is worth 950 by paying only 900. All right, A is actually going to pay 900, which is the strike price, and but he will receive a share which is worth 950, and therefore it satisfies the definition of a financial asset, which states that financial asset is a contractual right to exchange a financial asset to receive Infosys shares under potentially favorable conditions. So if, let's say, the market price increases, that is a potential favorable condition for me, and therefore I have a right to actually purchase Infosys shares under favorable conditions, which is actually going to be regarded as a financial asset. So from the point of view of Mr. A, this is going to be regarded as a financial asset. All right, from A's point of view, this will be regarded as a financial asset. Now, on inception of the contract, I am actually paying rupees 10 as premium. I'm actually paying rupees 10 as premium. I am going to record that 10 rupees as an asset. All right. Unlike forward contract, because there was no cash outflow in a forward contract, there was no journal entry at inception. But over here, we are actually making an upfront payment. Therefore, I will be recording a derivative financial asset on inception itself. All right, I'm making a payment of 10, and therefore I will record a derivative financial asset of 10 rupees. Why am I recording a financial asset? Because this gives me a right to exchange a financial asset or to purchase Infosys shares under potentially favorable conditions. If the market price increases, it gives me a right to actually purchase it at only 900. Therefore, it is a contractual right to actually exchange a financial asset with another entity under potentially favorable conditions, and hence it satisfies the definition of a financial asset. This is in the books of A Limited. All right, this is in the books of A Limited. Now let us say under scenario 1. All right, let us say we are actually under scenario 1. Under scenario 1, the value of the option is actually equal to rupees 50. The market price is 950, and therefore the value of the call option is actually equal to rupees 50. Therefore, in A's books of accounts, the asset should actually have a value of rupees 50 on maturity. On maturity, the value of the call option is rupees 50, and therefore the books of accounts of A should have a derivative financial asset of 50 rupees. Now, the books of accounts already have an asset of rupees 10. The books of accounts already have an asset of rupees 10. Therefore, I need to create an additional asset of only 40 rupees. I'm supposed to create an additional asset of only 40 rupees. So I recognize a derivative financial asset of additional 40, and the credit goes to P&L. Why is it going to P&L? Because all gains and losses on derivatives are recognized in P&L only. All right. How did I actually arrive at it? The fair value of the option contract on maturity was rupees 50. I already have a 10 rupees asset in the books of accounts, and I need to have an asset of 50 rupees in totally. Therefore, the incremental asset that I'm going to create is only rupees 40. After recognizing this journal entry, I am basically going to have a derivative financial asset in my books of accounts of rupees 50. I will have a derivative financial asset in my books of accounts of rupees 50. Let us assume that this asset is actually going to be settled physically. All right, if it is going to be settled physically, Mr. A is buying the shares of Infosys. Therefore, Mr. A will recognize investment in Infosys shares. He is going to recognize an investment in Infosys shares at its fair value of 950. I will be recognizing the Infosys shares at the fair value of 950. Although I've paid only 900, I recognize it at its fair value of 950. I'm going to credit cash of 900, and I will be crediting derivative financial asset. I will be crediting a derivative financial asset of rupees 50. All right, the derivative financial asset originally had a balance of 10. I increased it by 40. Therefore, the derivative financial asset is having a balance of 50, and I'm now crediting that derivative financial asset in my books of accounts. So the derivative financial asset will go down to zero once the contract is settled. All right, so I am going to recognize the Infosys shares at its fair value of 950 and not at the purchase price. Alternatively, if let us say instead of being physically settled, all right, this is the journal for physical settlement. If this was actually going to be cash settled, all right, the first journal entry A does not change. Journal entry B will change whether it's going to be physically settled or cash settled. If it was going to be cash settled, it basically means B will actually pay rupees 50 to A. All right, if it is going to be cash settled, B is going to pay rupees 50 to A. Therefore, the journal entry in the books of A will be cash debit of 50 because I'm going to receive cash and I credit the derivative financial asset of 50. All right, so the derivative financial asset is going to be derecognized because I've now collected the cash that I'm supposed to receive from B. All right, this is when it is cash settled. All right, so the first journal entry will stay the same. The derivative financial asset to P&L will remain the same, whether it is physically settled or cash settled. But the second journal will actually change depending on whether it's going to be physically settled or cash settled. This was about scenario one. All right, let's move to scenario two. Scenario two was where the market price is equal to 750 and therefore A decides not to exercise the option and hence the value of the option is falling down to zero. All right, the value of the option is actually falling down to zero. Now, if you think of it, I am not supposed to have any asset or a liability in the books of accounts on maturity date under scenario 2. Since the value of the option is equal to zero, I am actually supposed to have a zero financial asset or a financial liability. But in my books of accounts, I already recognize the derivative financial asset of 10 rupees. All right, I already recognized a derivative financial asset of 10 rupees. If you recall, I had recognized the derivative financial asset of 10 rupees upon payment of premium. Therefore, I'm now supposed to nullify that financial asset. I'm supposed to now nullify that financial asset, and the journal entry for that will be P&L debit to derivative financial asset. All right, so I am going to actually have a derivative financial asset credit of 10 because my books of accounts already have 10 rupees that I've debited into the derivative financial asset account. I am now crediting it because I'm nullifying it. The value of this option is now equal to zero. Therefore, I'm actually nullifying it by crediting, and the difference I'm actually parking it in P&L. I'm taking it to the P&L account. All right. So that is under scenario two. And over here in scenario two, I'm neither going to receive or settle any, I'm not going to pay any cash, and nor am I going to actually receive any cash. Therefore, there will be no further journal entry. There will be neither a physical settlement nor a cash settlement. Unlike scenario one, where I showed you the journal entries for both physical settlement and cash settlement, in scenario two, there's going to be no settlement at all. All right, there's going to be no physical settlement or cash settlement. So the only journal entry will be P&L debit to derivative financial asset. Now, if you look at it under scenario one, the profit and loss that I recognized was actually equal to rupees 40. This 40 is nothing but the 50 is the value of the call option on maturity, and I paid a premium of 10. So I have made a net gain of 40. All right, I'm receiving 50 rupees of gain on maturity, but upfront I actually made a premium payment of 10. Therefore, my net profit on account of this contract is rupees 40. All right, I've received 50 on maturity, paid 10 on inception, net gain is 40. Under scenario 2, I am actually my net P&L is going to be a loss of rupees 10 because over here I am actually not receiving anything on maturity and I have actually paid rupees 10. Therefore, my net loss is actually rupees 10. Now at this stage, I would actually like to clarify something. Earlier, I said that the value of an option can either be positive or at most it might actually fall down to zero. All right, let us say if I'm the buyer of a call option, the value of the option will either be positive or it can at most fall down to zero. All right, remember this sentence does not mean that I will not have a loss. This sentence, the fact that I said that the value will either be positive or zero, that is true with regards to the amount of cash flow on maturity. On maturity, I will either receive money or I will not receive anything. I don't have to actually pay any money. That is what I meant when I said that the value will be positive or at most be equal to zero. I do not mean that in case of option contracts, you cannot have a loss. All right, this statement of mine was true with regards to maturity date or on settlement date. On settlement date, I will either receive money or I will not pay anything. All right, therefore it can either be positive or at most be equal to zero, but that is not the same. That does not mean that I cannot have a loss in an option contract, because in an option contract, I'm making an upfront premium payment. And if on settlement, the cash inflow is actually equal to zero, if on maturity date, I'm not receiving any cash, then the amount of premium that I've paid is actually nothing but the loss. The value of the option on maturity is actually equal to zero, then the amount of loss that you incur will actually be equal to the amount of premium that you have paid, which is what we have actually seen in the journal entries in scenario 2 as well. All right, we are recognizing a loss in the P&L of 10 rupees. Now, obviously, just like in case of a forward contract, over here also there can be balance sheet dates in between. All right, let us say I entered into the option contract on 1st of March. The settlement is 3 months later. There can be a balance sheet date in between. And on interim balance sheet dates, we are going to recognize the call option at its fair value. We will be recognizing the call option at its fair value, with gains and losses being recognized in P&L account. All right, but the same principle, the value of a purchased call option can never go negative. All right, on balance sheet date also, just like on settlement date, the value of a call option cannot go below zero. On a balance sheet date as well, the value of a purchased call option will either be positive or it will at most be equal to zero. It cannot go negative. All right, you may have a loss. All right, I'm not saying that you cannot have a loss, but on the balance sheet, you will either show a positive value or you will show a zero value. You will never have a liability, unlike the case of a forward contract. In case of forward contract, we actually saw in illustration 3 earlier that we did that the value was fluctuating between positive and negative. That will not happen in case of an option contract. In case of an option contract, you will always have a positive value provided you have purchased the option. All right, if you have purchased the option, you're always going to actually have a positive value itself on the balance sheet. You can never have a negative value. Now, all of this that we discussed was actually in the viewpoint of the buyer of the call option. All right, from the viewpoint of a seller of the call option, every journal entry will be exactly opposite. All right, every journal entry will exactly be opposite, which is on inception, Mr. B has actually received rupees 10 from Mr. A. So Mr. B will actually record a bank receipt of 10 with a corresponding credit to derivative financial liability. All right, so it is going to be bank account debit 10 to derivative financial liability of rupees 10. Why are we recording a derivative financial liability? Because if you come back to the definition of a financial liability is a contractual obligation to exchange financial assets with another entity under unfavorable conditions. Under unfavorable conditions. What does that mean? If the market price goes up, B is still obligated to sell the share to A. All right, A has a right to buy, but if the market price goes up, B is still obligated to sell the share to Mr. A at rupees 900. Although the market price may be 950, I am obligated to sell it at 900 to Mr. A, which is an unfavorable condition for Mr. B, and therefore it is going to be regarded as a derivative financial liability. Under scenario 2, let us say in the books of B Limited, in the books of Mr. B, now, on maturity date, the value of the call option was actually 50 rupees, but that was 50 rupees positive for Mr. A. What is positive for Mr. A will actually be negative for Mr. B. Mr. B is obligated to sell a share at 900, but the market price is 950. Therefore, for Mr. B, the unfavorable condition is basically to the tune of negative 50 rupees. All right, he has an obligation to sell Infosys shares at 900, but the market price is 950. Therefore, Mr. B is actually having a negative value of 50 rupees. Now, therefore, in Mr. B's books of accounts, the derivative financial liability is supposed to be reflected at 50. The derivative financial liability is supposed to be reflected at 50. Why am I saying derivative financial liability? Because the value is negative. Negative basically implies a derivative financial liability. Now, in the books of B, we already had a derivative financial liability of 10. All right, we recognize the derivative financial liability of 10. We now need to have a total liability of 50. Therefore, the incremental financial liability that we need to recognize is only 40 rupees. All right, therefore, I am going to actually recognize a P&L debit of 40 and I will credit derivative financial liability of 40 again. All right, we already had a liability of 10. We need to increase that liability from 10 to 50. Therefore, I'm incrementally creating a derivative financial liability of 40 rupees. All right, the value was negative. Negative basically means a financial liability, and I need to recognize a financial liability of 50. But in my books of accounts, I already have a liability of 10, and therefore the incremental liability is only 40. Now, let us say this is cash settled. I'm just for the convenience, I'm assuming that this is cash settled. So on cash settlement, Mr. B is going to pay Mr. A 50 rupees. So the journal entry for that will be derivative financial liability debit 50 and to cash 50 rupees. I'm assuming cash settlement for the sake of convenience. I can also show the journal entries in case of physical settlement, but I'm not getting into the nuances. All right. So therefore, we are going to have two journal entries in the books of B on settlement date. The first is to increase the value of liability to 50, and the second one is settling the liability of 50 by payment of cash of 50 rupees to Mr. A. Under scenario 2, let us say under scenario 2, books of B Limited, the value of the option is actually equal to zero. All right, the value of the option is actually equal to zero for both the buyer and the seller. All right, in case of scenario one, for buyer of the call option, the value was positive 50, and for the seller, it is negative 50. Over here, under scenario two, the value for the buyer and the seller is actually equal to zero. Therefore, B's books of account should also not have any financial asset or a financial liability. B's books of account should also not have any financial asset or a financial liability. Therefore, we are basically going to reverse out the financial liability that we recognized earlier. We recognized the financial liability of 10 earlier, and now we are going to credit that 10 into P&L account. All right. So we are going to credit the 10 rupees to the P&L account. We are reversing out or we are nullifying the financial liability that existed in the books of accounts. This 10 is basically the profit that Mr. B has earned as a result of writing the call option. All right, as a result of writing the call option, Mr. B has earned a profit of rupees 10. All right, with that, we are basically done understanding the accounting for option contracts. All right, if I actually take a look at it, we have actually seen the accounting for option contracts in the books of both buyer and the seller. Now, the point to note is in case of a forward contract, as a buyer of a forward contract, you can have a financial asset or you may also have a liability. You can have both an asset or a liability on your balance sheet. Whereas in case of an option contract, the buyer will always have a financial asset. The buyer will always have a financial asset. The seller will always have a financial liability. This will be a positive fair value or at most it can be equal to zero. In case of a seller, it will always be negative or at the most it can actually come down to zero. All right, so financial a buyer of an option, although we saw an example of a call option, it is true for a put option also. As a buyer, you always have a positive value. As a seller, you always have a negative value or zero. All right, zero is the utmost it can actually fall down to. All right, so the buyer will always have an asset and the seller will always have a liability. Does that mean that the buyer can never actually have a loss? I'm not saying. I'm talking from a balance sheet position point of view. All of this discussion is from a balance sheet position point of view. All right. The buyer of a call option can also have a loss because he's actually going to make a premium payment. All right. But on the balance sheet, at most the value can actually go down to zero. There can never be a liability for a buyer. All right. The buyer's liability is actually extinguished once the premium payment is made. Once the premium payment is made, buyer actually no longer has any liability. Therefore, the value of the option contract will always be an asset. All right. Whereas it's going to be the opposite for a seller of an option contract. We have actually seen the journal entries in case of a call option. I'm not separately going to actually discuss the journal entries in case of a put option because the transaction actually remains the same. Only when is it exercised and when is it lapsed, that determination changes between call and put, but remaining everything remains the same because a buyer pays a premium in case of a put option also, and the seller actually collects the premium. The only difference is put option is a right to sell an underlying, call option was a right to purchase an underlying. All right. So in case of a put option, it's a right to sell, but the buyer over here also pays a premium to the seller, and the fair value will also keep fluctuating. The only difference is when is it exercised and when is it lapsed. That will actually change between call and put. In case of a call option, we said that the option will be exercised by the buyer when the market price is greater than the strike price, whereas in case of put option, it will be the opposite. All right, the buyer of a put option will exercise the put option when the market price is lesser than the strike price. All right, that's the only difference, but everything else, journal entries and accounting wise, it actually stays the same. All right, so I'm not going to discuss put option separately. In fact, the illustration that we have in the institute is actually in the context of put option. So indirectly, when we do that illustration, we're actually probably going to also see the journal entries in the context of a put option, but the journal entries exactly are going to remain the same as what they are for a call option. All right.